Hi, Steve Sosnick here with today's Interactive Brokers midday market update for Wednesday, April 29th. Um, I'm going to title today's piece Full on FOMO, and because I really do think that's what we're seeing right now, particularly as we get into the end of a calendar month. March was a down month, and as I mentioned and written before, a lot of what we saw in March was exacerbated, much made worse by the huge open interest into the quarterly expiration, much of which couldn't be rolled, et cetera. That was a factor that drove us probably lower than we would have or should have been. The oil debacle that we saw a couple of weeks ago was from a similar vein, where you had expiration crises, and calendar events do have a role. And I think as we get into the end of April, we're seeing portfolio managers say, you know, I want to be fully invested in April. I want to be invested in the winners, and I think that is a large amount of what we're seeing. In the stuff driving today's market, the Google news was mixed on the surface, beating revenues, missing earnings. There was some good commentary. Google is not the most transparent of companies in terms of they typically don't provide a lot of guidance. And so in this case, you saw the market react well on what was perceived to be a positive conference call, green shoots, if you want to call it that. Google would be one of the first places that would see some revenue gain if the economy is coming back, because people would be searching for things. And I think they're searching for things now because they're not able to get them in normal places. So we'll take that as a good sign. That was one of the keys to the do earnings matter feature, and that's one of them. You know, so far so good. Some other stocks less so. I do expect to see a lot of mixed earnings. The other piece of news we got this morning was GDP was minus 4.8. That was worse than expected. An interesting comment I saw Mohammed Al-Arian, who I respect immensely, saying that if you think the first quarter is bad, the second quarter is going to be worse. Which, considering markets are supposed to be looking ahead, that's probably not a good sign. But almost simultaneously with the bad GDP release, there was news from Gilead saying that there was some positive results from their coronavirus drug remdesivir, their antiviral remdesivir. I'm less bullish than the market on that, and here's my logic. For the market to really recover, for the economy to recover, people have to go back to doing what they did before at similar levels to what they were doing it. And a drug that needs to be administered to critically ill patients to keep them from dying, which is a good thing, is not going to change people's behavior. That's basically, a miraculous stick save by the goalie after a breakaway. You're not going to pass away, which is that's the ultimate good news. But in terms of socially distancing, being able to operate in a normal environment, I still don't think you're going to see that until you get a real vaccine news, or a real, I'm going to call it a Tamiflu equivalent, some sort of antiviral that you take it at the first symptoms and it turns it into, fairly mild cold. You're off your feet for a couple of days and then you resume. I think most people would sign up for that. So I'm a little perplexed at the market's complete enthusiasm for the Gilead drug, and I find that is insufficient as a rationale for why we're up 2% at this point. So I'm going to go back to the old saw, FOMO. The final thing we get to see today, and as I'm taping this, we don't know what's going to come out, is the Fed annual meeting and press conference at 2 o'clock. So much of what we're seeing is predicated on the Fed. It's a liquidity-driven rally. We're seeing the Fed balance sheet expand at record rates. And I think it will be very interesting to hear the commentary, although in a strange setting, sort of a virtual press conference, if you will, as to what Chairman Powell is going to say. And, I've written before that the Fed has pretty much gone to 11. I don't know what the market still expects from them. I guess some of the measures that the Fed have taken haven't fully kicked in. So it'll be very interesting to see, does the Fed move the needle in a positive way? Considering the spike that we're up, I don't know, can they? Let me leave you with a couple of other thoughts. And I think we're going to work on these over the next couple of days. Markets are pretty much back to where they were last fall, as are PEs. Now, PEs are somewhat meaningless right now, certainly backward-looking PEs, because looking forward, we have no clarity. Virtually no company is giving any guidance as to what they see going forward over the next few quarters, over the rest of the year. And that's what a stock market should be discounting. So let me ask you the question, what's different this time? Certainly the economy is worse. Forward earnings guidance would have to be worse. Whatever the market was projecting 6 months ago, it can't be projecting that now. So it's liquidity. It comes back to the Fed and it comes back to psychology. Last August, we were seeing the beginnings of the repo crisis. So the psychology was bad. The Fed pumped in money. Now we're seeing a much worse crisis. Psychology is bad. The Fed pumped in money. Can this persist? We'll have to see. As of today, I'm putting it off to some seasonal factors, some momentum, some good news, but I think somewhat irrelevant good news from a market perspective, unless you're a Gilead investor, of course. And we'll see where this takes us. Take care. Bye-bye.